Hey folks, I'm your host, Robin Lin, and welcome to another episode of Zoom Out with TouTzuSays. I'm going to be updating my crystal ball predictions from January. Today is March 7th, 2024, and let's get started. As per usual, remember I am biased, I have blind spots. This is for your entertainment only. This is not investment advice. So to recap, here are my 8 predictions for 2024. I started by saying that I think this year will be a stagflationary year for the US. So far, it looks like the projections for our GDP, at least for the first quarter, have been declining. And I think it's relevant to note that inflation has actually started to move back up since January. The services component of the ISM index is indicating that prices are still high, but growth is slowing. So they believe also we're moving towards a stagflationary period. After a banging fourth quarter last year, January retail sales have collapsed. And credit card delinquencies are on the rise. Job openings are starting to come down, and we're seeing quit rates start to fall. This is an indicator that people aren't willing or aren't feeling that the economy is robust and they want to hang on to their jobs and rather than switch jobs. This is a good indicator. The quits rate is a good indicator of the wage growth going forward. So we've had great wage growth over the last few years. It's starting to slow down. Interestingly, jobless claims have actually stayed at a very low level, which is typically a very robust and positive indicator. However, warn notices are starting to rise again. And remember, warn notices are for larger companies. They can't just lay people off. They have to file a warn notice with the government that says that in 30 to 60 days, we intend to lay these people off. So as warn notices increase, we are likely to see weakness in the labor market. Overall, I think the US economy is definitely slowing down, but it doesn't seem like it's at critical recessionary level. I think it just kind of hums along, probably weakens through the rest of the year and into the elections. I did mention that there are potential black swan events. One of them was the commercial real estate market, which has been deteriorating and causing some trouble with other regional banks. As you can see, a lot of commercial real estate last year started to be cut down. And of particular notice, the office markets, the office building markets seems to be really under distress. I think it's probably something that can be managed. Even though many big investors are going to suffer, we're going to see continued pressure there. Regional banks will continue to be pressured here, but it's also a known. So I think that the banks, with the help of the Fed, probably can make sure that this doesn't blow out of control and cause a systemic financial issue for the markets. But we'll see how that turns out. Net net, I still think that the US economy is not going to be dropping below zero for the rest of this year. And although inflation is still sticky, it's something that can be managed with the relative robustness still of the US economy. I think the sectors we're still looking at are maybe in defense and semiconductors, that we can continue to enjoy market growth in these sectors. I said in January that I think inflation would be rebounding in 2024, and so far that seems to be the case. It doesn't matter which CPI inflation measure that you use, whether it's CPI, supercore CPI, PCE, which is the Fed's favorite inflation indicator. Overall, what we are seeing is that inflation did come down in Q3, Q4 last year, but it's starting to rise up again, on top of the fact that spending, retail spending, seems to be declining. Another great indicator of future inflation is the PPI, which is the Producer Price Index. This is the inflation rate for, say, manufacturers when they're importing raw materials and goods. This has been rising as well. So given the fact that I think the economy is not going to be terrible in the US, and inflation probably is continuing to rise, I believe the commodity sector, the energy sectors may continue to do pretty well. I've mentioned before that I think global liquidity is a major factor in how risk assets perform. Here's a great chart. The top half is showing that even though the Fed is lowering their balance sheet with using quantitative tightening, we had this deposit of cash in the reverse repo markets, and that has been actually fueling liquidity in the markets. So on the bottom half of that, you can see net liquidity is declining in 2022 and started to rise at the end of 2022 into 2023. If we overlay how the stock market did, that's a pretty good indicator of how liquidity plays an important factor in how, say, stocks perform. If I'm not mistaken, and I believe going forward, we're going to continue to see more liquidity as the QT program probably is going to end. And we have an election year where governments tend to want to support the economy and stock markets. My forecast is for net liquidity to continue to rise into 2024, maybe even into 2025. With greater liquidity, financial conditions for lending start to ease, and that bodes well for the global economy. Meanwhile, most forecasts are for the major economies of the world to start to lower interest rates as inflation remains within control, and there are times that they want to start stimulating their economies for higher growth. Net net, as liquidity continues to rise, it means risk assets will continue to outperform even unexpectedly. I think we remain bullish on stocks, we remain bullish on emerging markets, growth, even alternative assets like crypto and gold. Although it's only been a couple of months since I expected the global geopolitical tensions to calm down, so far so good. We don't have anything new going on in the Ukraine. U.S.-China relations are on par. They're not getting worse. In fact, China is probably being a little bit nicer with the U.S. in order to try to regain the economic vitality that they used to have. And the war in Israel and Hamas, that's kind of just gone sideways. Nothing new going on. No real escalations except for the Houthis trying to attack ships in the Red Seas. So worldwide, there are two major canals. The Panama Canal, which is suffering drought, and they're having a hard time getting the volume of ships through the canals. The other one is the Suez Canal, and the Houthis have been attacking ships that are in the Red Seas, and that's caused all the ships to not use the Suez Canal and reroute all the way down the southern part of Africa all the way around up to Europe. So here's just a quick chart of the volume of traffic through the Suez Canal, and it's affecting global goods, energy prices. So this is another factor for, it's an inflationary impulse that causes PPI to rise and possibly then inflation broadly. So this is the main factor, main repercussion of the war in Israel against Hamas. When does this die down? Who knows? But this is something that is a manageable risk in the geopolitical world. For 2024, broadly, I'm expecting the dollar to start to weaken. And it's still too early to say. It's kind of up and down. It depends on each currency. But it looks like the first real major currency to strengthen against the dollar looks like the yen. And we'll see if the other major currencies, specifically the euro, will start to feel the same effects later this year. I'm relatively bullish on the commodity producing countries and currencies like the Australian dollar, Latin America. I think that this chart shows when we have dollar weakening, we develop excess liquidity in those markets, which tends to be positive and bullish for those local markets and stocks. If I'm correct that the U.S. market, the U.S. economy is not going to collapse, demand for commodities and goods is probably going to remain better than expected. So the commodity producing countries and the commodities themselves ought to do better in a weak dollar environment. At the end of the last year, I started to get bullish on Bitcoin. And so far, that has been playing out well. There were regulatory issues. Bitcoins are now officially sanctioned by the SEC, and then bam, there were like 10 new ETFs of Bitcoins, and it's driven a lot of interest and support in the market. We've moved from the 20,000s to the 40,000s now to 60,000s Bitcoin. It looks like this still might have legs. Some technical analysts believe that if they can maintain the $64,900 level past this weekend, it could continue up to 80,000 in short order. To make sense of that 80,000 number, we have to realize that these ETFs, when you put money into them, when somebody buys one of these ETFs, they're forced to go and buy the Bitcoins that's available on the market. Recent ETF buying has been in the $10,000 Bitcoins per day, but what you actually are mining is something like 900. That's a huge supply and demand imbalance, which tends to be very positive for the Bitcoin price. Furthermore, there's something called the halvening in the Bitcoin world, where every 4 years they reduce the payouts, how many Bitcoins you can actually earn by mining them. So every 4 years, and the next target date is somewhere in April, will be the next halvening, and it tends to, again, ensure that supply is even more restricted. So a lot of people are expecting that Bitcoin after the halvening will continue to still have price support and the prices continuing to move up. So net, I'm still bullish on Bitcoin for this year. I think that although it's extremely volatile, it moves in big jumps and gaps. There are more and more people that feel comfortable to use ETFs to buy Bitcoins in their portfolios. They can buy in large amounts. That means family offices, institutions have an easy and legal way of participating in this market. One of my predictions was the weather effect of El Nino on U.S. crops this year. So far, hasn't played out clearly. All the agricultural stocks have just made bottoms recently. They've all been down. However, the effect of El Nino, and they're calling this year a super El Nino, we may still be seeing those effects play out over the next couple of months. Over the winter, this chart gives a good idea of what happened, where some parts were warmer, wetter, drier. Remember, the breadbasket of America's agricultural powerhouse is right in the middle. And with a relatively mild winter and not enough snow, they didn't actually build a lot of water for them to continue growing in the spring and summer. So that's something to be watched, and we'll see how that plays out. Meanwhile, overall inventories in the US of corn, at least, have been extremely high. Corn prices have been under pressure. And part of the issue is China is purposely buying more from Brazil than from the US. So there are global factors with that. But going forward, there's still some potential stress in the agriculture market. So let's keep watching and see how that turns out. And finally, all eyes are on the U.S. presidential elections. We've been watching Trump versus Haley. Trump has won out. Nikki Haley is withdrawn from the race. So now it's very much a Biden versus Trump narrative, although there is a third party candidate, Robert Kennedy Jr. Because there's so many lawsuits and media and all these factors going on, the U.S. is probably going to get more and more divided going forward into the elections. Who knows how the rhetoric goes? Who knows how health conditions evolve? Also, the war in Israel has been very polarizing for many Americans. Let's see how these go. I think, though, if you are a CEO or investor, come this summer, I think you're going to find that there's not much clarity on who is actually going to be able to win the presidency. And in that kind of scenario, you probably want to withdraw and take it easy and just wait for the outcome. You don't invest, you don't hire, you don't make big strategic plans because depending on who the next president is, all the U.S. policies could be exactly opposite, and you can't make big bets with that kind of uncertainty. That means investing wise, you can only invest in things that are fairly sure bets. I think defense spending is going to continue. Spending in semiconductors, building those out, that is going to continue. Perhaps some reshoring of manufacturing and technology. Those are going to be policies of the US, regardless of if it's a Biden or Trump presidency. I think that also means that if the dollar does weaken because of the uncertainty, it makes emerging markets a lot more interesting. So in summary, I think 5 out of 8 of my crystal ball predictions are playing out as expected. The other ones, I think we need a little bit more time to see how they evolve. Broadly, that means the investment themes that I've outlined here, I continue to believe in them unless something dramatic happens in the world. So, happy investing. Feel free to reach out to me if you have comments and questions, and thank you for watching.